Hello and welcome. My name is Vikram Chandra and you're watching This World, a show that wraps weekly developments from around the world and keeps you on top of the biggest global stories. This week's biggest headlines have been coming from China. It seems to be facing some sort of a financial meltdown. The economy is not in the best of shapes. The GDP growth rate has slowed down. The debt has nearly triggered a big question. Has China's growth story hit a roadblock? And if so, what is the reason and how long is it going to last? Is the government's policies to blame or is it something else? Also on the show, the Hunter Biden legal drama has intensified with reports suggesting that the US president's son could be put on trial. Why? Because the plea deal he filed seems to have collapsed. We'll tell you all about it a little later on the show. And also, can animal organs save human lives? Some scientists say yes, they've just transplanted a pig's kidney into a brain-dead person. What they discovered is truly startling. All of that lined up for you on the program today. But let's start by taking a look at China's economy. And China's economy, quite frankly, is in a bit of a mess. Every week, it seems to be facing new troubles. Every week, there's a new headline coming out about impediments that China is facing. The latest one should worry Xi Jinping. It says China is likely to miss its growth target of 5% this year. The prediction has been made by several major banking giants. JP Morgan Chase is just one of them. It has further lowered its full-year forecast. In May, the bank had predicted a 6.4% expansion. Last week, it lowered it much lower to 4.8%. So did Barclays. It has cut China's growth rate estimate to 4.5%. For the unversed, China's official target for this year is 5%, which means it's aiming for 5% GDP growth. But if we go by the wave of downgrades, it seems that China is not going to be able to meet its own targets. The timing of these downgrades is, of course, particularly interesting. They come amid a slew of disappointing economic data. Earlier this month, there were reports about China's Great Wall of Debt. According to a new Forbes report, China's overall debt, both in the public and in the private sector, has risen to a colossal $51.9 trillion. I repeat, $51.9 trillion. This is the highest level recorded in the last 27 years. Now, of course, China's economy has been growing, so debt will go up, but the present debt levels are almost 3 times the size of China's economy. And that's not even the worst part. Reports say that China's debt is inching closer to the IMF's red line. Let me explain. According to a report released by the National Institution for Finance and Development, China's household debt has increased from 61.9% at the end of last year to 63.5% in the second quarter of 2023. Now, this may be only a slight jump, but it has taken the debt closer to the International Monetary Fund's warning point of 65%, a level that indicates potential financial risk. Next, we have unemployment. It's also at a record high. Reports say that the urban employment rate for people between the ages of 16 to 24 has risen to 21.3%. Now, this figure is so bad that Beijing has decided not to release figures anymore. I'm not making this up. Look at what The Guardian states. China has suspended the release of youth unemployment figures. Why? Because it wants to improve and optimize labor force survey statistics. Now, I'm still trying to figure out what exactly that means. How do you improve and optimize statistics, especially if they are so bad? Well, I'm sure we'll find out. And then we come to the property sector. Reports say that China is facing a housing market slump. Home prices have been falling for 16 months straight. Land sales, which account for 40% of all local government revenue, have also collapsed. I have a report with me which says that sales of new residential properties in China have tumbled around 28% as compared to last year. And if we speak of investment in property development, which is a vital driver both industrial and consumer demand, it sank 7.9% in the first half of this year compared to a year earlier. Analysts say this is a troubling sign of persisting weakness in industry. Now, what does all of this tell you? That China's property bubble could be bursting. That mighty real estate sector that was behind so much of Chinese growth for a period of time could be crashing. And this is worrying for China because this sector accounts for around 29% of the Chinese GDP. It accounts for around a quarter of domestic output, almost 80% of household assets. Around 100,000 companies operate in this sector. This makes it the nation's second biggest employer, providing around 27 million jobs to Chinese citizens. All of this could be under threat if the property bubble actually collapses. Now look, let's be fair and let's be clear on this. China has seen a major economic miracle for a long period of time. Look at the way the Chinese GDP has grown, the Chinese economy has grown. And yes, there will be ups and there will be downs. But the big question that some people are asking, have a lot of the ups of the last 10 to 15 years been because of something that was unsustainable? Unsustainable investment, a wrong savings investment ratio, building of property and real estate and other assets that had no real demand for them. Other policies that have been faulty. Because if any of that is correct, then it's not cyclical. There's something structural there that could go wrong. And unemployment, of course, is particularly important because it could have political implications for one man, Xi Jinping, the person who's been under very muted attack. His draconian zero COVID policy and what that did, his bizarre decision to limit debt to developers, and his usual playbook of using large-scale stimulus measures to boost demand, perhaps unsustainably. Perhaps all of that led to a massive oversupply in many sectors. So let's now spend some time trying to figure out just what is going on in China. How bad are the problems there, and what could be the impact on the rest of the world? And for more on the situation in China, we're now being joined by Vishnu Vardhan from Singapore. He's Executive Director and the Head of Economics and Strategy, Asia and Oceania at the Mizuho Bank. Thank you so much, Vishnu, for joining us. When you're looking at China right now, it's suddenly beginning to seem almost as if the wheels are coming off. What's really going wrong there in China?
Well, I mean, that's a really good question. And to be honest, we've been fairly concerned about China's situation for a while now. But what's really going wrong at this juncture is clearly the fact that the economy is in a state where simply providing liquidity via the banks isn't resolving some of the pre-existing solvency crisis. I mean, typically what we say is, look, this is a liquidity crunch, it's a liquidity situation. If we don't want it to devolve into a solvency crisis, we should be very quick with liquidity. This time around is quite different because the property sector, big parts of it are already in a bit of a solvency crisis. Hence, providing liquidity in and of itself doesn't solve the problems. And the problems that we're referring to here quite specifically pertain to a sheer loss of confidence. So the confidence deficit in the economy is mind-boggling. So consumers are not spending. Very, very critically, they have lost confidence in the property sector. So they're not buying property, which means the property developers are all in problem. And that has seized up cash flow in the economy because the wider economy, over 30% of the economy, whether through direct business or ancillary business, depends on the property sector. And that includes local governments who rely on land sales by property developers for their revenues.
So, there's one thing. So, yeah, sure. let me just try and break that up a little bit to help people understand this from a distance. Look, there will be cyclical ups and downs in all economies. It'll happen in China, it'll happen in America, it'll happen in India. The question that I think a lot of people are asking is there something more structural that is happening in China? And I'm not to put too fine a point in it, a lot of people are also saying that what essentially happened in that decade of spectacular growth that we saw in China, 2005 to 2015, and that period onwards, a lot of it was just inflation, like they were just pumping in money. People were building real estate left, right, and center. Infrastructure was being built, which may not have had a use. And now, frankly, it's a bubble that is starting to pop. That would be the doomsday scenario. Do you think there's any chance that that is what's happening?
This time, there's a huge structural component to it. I don't think it's isolated structural or completely cyclical. But the three parts of the structural, one has got to do with what you said, which is we've had more than a decade of just the kind of mind-boggling credit push. So very high leverage in the economy means that they are now struggling to boost growth further via credit. You also have a demographics that shifted, but structurally, the other big thing here is that there seems to have been a change in terms of the policy.
So let's break that down further. I was talking about some of the wheels of the Chinese economy that have been ticking. All of this has also been predicated on a lot of foreign companies coming and setting up their FDI investment into China, and China as the manufacturing engine of the world. Chinese exports, and that has been the real driver of the Chinese economy. If China is fighting with half the world, as it seems to be doing right now, then the issue is people are diversifying away, moving away, and if that export engine starts to dry up, it compounds the problem then.
That's certainly a point to be made. In the near term, though, what it just means is that it's going to be fairly disruptive in the sense that costs will have to go higher in the near term, just as we're looking for alternatives, trying to scale up, so on and so forth. So in the very near term, apart from situations where there's explicit restrictions or punitive tariffs on trade, China might still retain some of the runway of advantages it has built up over the years. But that can erode very quickly, as you rightly point out. I mean, the geopolitical situation, along with the domestic political control over the socio-economic situation, these two factors may be the biggest factors that would, I think, retard China's growth potential. So that's where we see the risks residing. So we're not so fussed about whether China will do 5% or not this year, because our worry is that they will struggle to get underlying growth above 4%. And that remains a reality to be dealt with.
But the real doomsday scenario for China, the real scary situation for the leaders of China would, of course, be unemployment and youth unemployment, and that going into social strife of some sort. I mean, that's of course what they are most concerned about. Now, if you start having youth unemployment numbers reaching levels which are so bad that the Chinese don't want to publish them anymore, then there's always that risk of political instability, which for the Chinese Communist Party is the worst possible thing to happen.
I cannot agree with you more. I think everything about the Chinese Communist Party is about control. Having control means they need financial, economic stability, they need social stability, and they need political stability. And you touched on the aspect of social stability, which also has got very tight linkages to the economic stability and the economic well-being. So these two are inextricably linked. And you're right that this poses a very dangerous situation.
Vishnu, thank you so much for joining us. It really helped us clarify to a great extent what's actually happening inside China right now. Thank you so much for being with us.